just had another one come through on the SMS just to follow up on the DMF structure. So this question is asking about, given people are living longer, is the DMF still the right structure going forward? Or perhaps should you tweak the DMFs? If we say on average they're 10 years, capped at 10 years, we know some of them are starting to tag on beyond that. Any thoughts on those?
Well, if I had the choice of getting all of it up front, I'd probably take that. But it goes back to that point about balancing the needs of your customer with the needs of your investor. So there will be changes to the DMF model over the years ahead. There's no question. As any industry changes, things change a bit. And as you get different owners and different investors in this space, they will all look at different options to the DMF. But the DMF works, and it works for our customers. And it's not something that's that I see having wholesale change in the short to medium term. That doesn't mean it won't be tweaked and there won't be other options available, but it works for our customer.
Anyone else want to comment on that? No? Okay, we got a few to get through, so that's all right. Back to something that you said earlier, Janice, and that's regulatory framework, right? So if we're talking about we want capital flows to come in, well, we have domestic capital, and there is a bunch of that, but there's a lot of the foreign capital, and so on the tax laws, obviously it comes down to we want to make more money, so if you're asking them how to change it, it's like make us pay no taxes, but just a more view on what would be more acceptable tax laws.
That would involve an overhaul of your tax system.
This is a question that came through there as well. Could it be increased or encouraged by changing the tax laws? I know, Chris, you have a view on that?
Look, MIT would be a logical jumping off point.
Yep.
It would, again, from a perspective of an outside investor who's looking at an office tower, a hotel, a retirement village, or a land development, it would give a lot more clarity if it was to be brought into the MIT regime.
Yep.
As it stands, it's not particularly well dealt with from a tax perspective. So that would be, if I was to advocate a simplifying assumption from an external investor's perspective into the market, it would be try to bring MIT to retirement.
To retirement. Steve, you seen anything of that when you're investors?
No, I think it's an interesting sector because I think the way it's currently structured, it encourages kind of private high wealth individuals to invest in the sector because you get the upfront tax deduction and your income's deferred. So the history of the sector kind of lends itself to that, and the tax laws play a part of that. From our point of view, we don't see any issues with the current tax treatment. And it's not a issue from a retirement perspective that we hear a lot about from our investors. It's not front of mind. They're about return.
John, any comments on that from tax? No, you're not a tax lawyer, John? Come on, in your spare time. All right. Let's see. We're going to open the floor for those of you that don't want to send your questions through the SMS here. So I'll actually start that now. And typically there'll be no hands, and then as time ticks down, people will have all these hands. But we do have a question over here. All right, got one starting right over here.
Hi, Stuart Nicholson. Just on that tax question, there's a lot of or a bit of uncertainty and speculation around the tax treatment on the transactions of villages in relation to the GST and stamp duty and so forth. To what extent do those uncertainties create a question mark over the investor's appetite and I suppose more broadly the changing regulatory environment that we seem to be living in all around the country? To what extent do those uncertainties create a bigger question mark for the investor?
Chris, I'll let you kick that one off.
If only we had someone from PwC on this stage. Look, regulatory uncertainty, I guess, is something that, we live with, and it's not, unfortunately, sequestered to this industry. It is across, real estate generally, and I guess if you've moved into, the aged care, you'd probably have a bigger regulatory question mark over the space than perhaps we do in independent living and the business that you're in, Stuart. So for me, I think it's something to be watched. It's something that we will continue, through these bodies to advocate the position to government, and then when they make up their mind to tax us more, we'll whinge. So that's, my perspective.
Other perspective, guys?
Uncertainty always creates challenges. There's no question about it. And whether that's uncertainty in the tax treatment, whether that's political uncertainty, where there's uncertainty, that's a problem. And you saw that in the aged care sector, I think, over the last couple of years, where you had a period of legislative uncertainty, and with the changes that have come out over the last little period, you've started to see some transactions happen. So as investors get more comfortable with the legislation, they're more likely to invest. So from a broad perspective, uncertainty doesn't help, but we're not seeing any specific issues in that space when we're talking to our investors at the moment.
Guys want to add? John, Janice? No? Just as a clarification that came through here, a cheeky little SMS. What is MIT? Chris, you're going to talk about our managed investment trust. So it's just a tax structuring for offshore investment into Australia.
15% is what it means to us.
Okay.